Two facts sat side by side on Friday that refuse to coexist. Macquarie Group posted one of the largest annual profits in its history, net profit of $4.85 billion, up 30%, and its share price fell anyway. Not because the result disappointed, because Brent crude crossed back above $100 a barrel before Australian markets had finished their morning coffee. The trigger was a naval exchange in the Strait of Hormuz. U.S. Central Military Command launched what it described as defensive strikes on Iranian positions near Bandar Abbas. Iran called it a ceasefire violation. Oil traders did not wait for a press conference. Brent climbed more than 2% in overnight trade, erasing a week's worth of easing. The S&P ASX 200 opened down and kept falling, closing 1.51% lower, its worst single session in 7 weeks. The Strait of Hormuz is not an abstract geopolitical concern for Australia's market. Roughly 20% of global oil flows through that waterway, and it has been partially disrupted since March. Each disruption cycle has a now familiar pattern: a day of optimism when peace signals emerge, a day of selling when strikes resume. Friday was the reset day. Banks led the damage. Westpac fell close to 4%, though part of that was the ex-dividend effect. Commonwealth Bank dropped 2.37%. National Australia Bank fell 2.61%. BHP slays not confined to one sector. It was the market pricing a single variable. How long does this last? The question that the closing bell did not answer is whether Friday's drop was a one-day panic or the start of a repricing. Oil at $100 is uncomfortable but survivable for Australian corporate margins. Oil sustained above 100 with second-round cost pass-through into transport, freight, and construction is something else entirely. The Reserve Bank said as much in its own language this week, and that is where the next chain begins.
The Reserve Bank delivered its third consecutive 25 basis point rate increase on Tuesday, bringing the cash rate back to 4.35% in an 8-to-1 board decision. The language was familiar: inflation above target, second-round effects from fuel costs, gradual transmission. What changed is what comes next. Westpac's chief economist, Lucy Ellis, now expects the next 2 hikes to land in August and September, not June and August as previously forecast. The shift is subtle but meaningful. A dissenting vote on the board and Governor Bullock's framing of the May decision as creating space to assess Middle East fallout were both interpreted as signals that a back-to-back June move is no longer the base case. Ellis is careful to call this a timing shift, not a direction shift. The underlying inflation view has not softened. It has, if anything, hardened. The counter-signal here is worth naming. Westpac's oil price assumptions in its May forecasts sit above the futures curve used in the RBA's own projections. If oil eases faster than Westpac assumes, say if a ceasefire in the Strait holds, the bank's inflation trajectory drops, and the August-September hike timeline may compress back toward 1 move rather than 2. But if the Strait remains partially closed and businesses begin passing fuel costs into services pricing, what Westpac calls second-round effects, then the RBA's own published concern becomes a self-fulfilling forecast. The practical consequence is already visible in housing data. National dwelling price growth slowed from 6% in January to 2% in April. Sydney and Melbourne prices are now falling. Rate hikes are biting, and the demographic of borrowers most exposed has shifted. Census data shows the share of Australians aged 55 to 64 who own their home outright has almost halved over 2 decades. A household 5 to 10 years from retirement carrying a 6.9% mortgage is not a marginal case. It is increasingly the median case. QBE Insurance noted its core fixed income yield rising to 4.1% from 3.7% in FY25, a direct benefit of higher rates. The insurance sector earns more when rates are elevated. Banks face a different calculation: higher funding costs, slowing credit demand, and a borrower base under growing stress.
Macquarie's results is the clearest illustration of what geopolitical risk does to earnings signals. The company reported a record second-half profit of $3.19 billion, 93% above its first half, driven by a 49% surge in its commodities and global markets division. That surge was not despite the oil volatility. It was partly because of it. Macquarie is one of the world's largest commodity trading and infrastructure financiers. Elevated energy prices and volatile markets are, for a firm of its structure, revenue-generating conditions. That same volatility is what pushed the share price lower on Friday. A market that sells everything when oil spikes does not pause to read divisional breakdowns. The result reached investors at the worst possible moment, a day when macro fear was crowding out company-level analysis. Macquarie ended the session down between 1.5 and 2.2%, depending on the timing, against a backdrop where its underlying return on equity had improved to 14% from 11.2% the prior year. Final dividend was declared at $4.20 per share, 40 cents higher than last year's final payout, partially franked at 35%, with the next dividend date of May 18th. REA Group and Block offered a different read on the same day. REA's third-quarter EBITDA climbed 16% on 11% revenue growth, driven by residential listing volumes and record monthly audiences of 12.9 million Australians. Block reported a 27% jump in gross profit to $2.91 billion and upgraded its full-year guidance. Both rose against the broader market decline, suggesting that where earnings signals are clean and unambiguous, investors are still rewarding them. The forward conditions now rest on two thresholds that are visible and checkable. The first is Brent crude. If it retreats sustainably back below $95, the RBA's space to assess framing gains credibility, and the August hike timeline becomes genuinely uncertain. If Brent holds above 100 through the June quarter CPI reading, due in late July, the August hike is effectively locked. The second threshold is the Macquarie ex-dividend date of May 18th. A share that trades lower, despite a record result, then goes ex-dividend, faces a technical double headwind. Whether buyers return at that level would tell the market something about how much of Friday's selling was Iran-driven panic and how much was a genuine valuation reset. The answer is not yet in the price. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.